And that was essentially market bifurcation. It's led to some opportunities in high quality small caps kind of heading into 2024. We've already seen this in our Canadian small cap portfolio, really pronounced in October, November, where we see a real jump up in terms of some of the high quality names there. We'll start off by saying 2022 was a profoundly negative year for North American stocks. Somewhat surprisingly, 2023 has seen a significant recovery. While not recovering all the losses in most cases, indexes have made a significant move forward in 2023. But like I said, the market is bifurcated. Now, if we look at the S&P 500, it was down 19.3% in 2022. It's recovered in 2023 and is now up 19.2%. The NASDAQ, which was down 33.1% in 2022, is now up 37.79% year to date. While the recovery on both the S&P 500 and the NASDAQ indexes appears strong, the headline numbers are a bit misleading as the gains, particularly if you look at the start of November, where some of this data is coming from, is entirely powered by the mega cap 8, Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, Nvidia, and Tesla, which account for over 27% of the entire S&P 500. Now, to better illustrate my point, while the headline numbers show the S&P 500 or the 500 largest stocks in the U.S. market to have gained roughly 19.2% year to date, it looks like a decent recovery, a strong recovery. However, if we remove the mega cap 8, it's really a tale of two markets. These stats are at the start of November, but there's somewhat of a change, but not a significant difference. If we look at year to date, the 2023 on an equally weighted basis, we're going to use the Magnificent 7, roughly the mega cap 8. Average gain was 71.36%. The other 493 stocks, the average loss was 4.26%. Now, below, we're going to look at a statistical representation of the disparity in the returns between the mega cap 7 stocks and the other 493 stocks on the S&P 500. The 493 are in gray there. The mega cap 7 are in whatever the heck that color is, that other color here. I'm going to call it like a pastel salmon. As you can see, the salmon mega cap 7 has significant positive gains, and the other 493 stocks in gray are down and had been down in 2023. All told, the majority of Canadian and U.S. stocks on average are having a rough to average year in 2023, despite what the headline numbers say. If you want further proof of this, look at the year-to-date performances on a couple of Canadian indexes that do not include the mega cap 8. You can see here, year-to-date, the TSX is up just slightly, just 3%, and the S&P TSX Venture, that sad exchange, is down in 2023, despite what has been a really significant rally in gold. You can see there. So let's take a look at broader market valuations from a historical perspective before we zero in on where the opportunities may lie in the current market. Now, one method or metric that we like to look at is the Shiller PE. It's a more reasonable market valuation indicator than the regular PE because it eliminates fluctuations, the ratio caused by variations of profit margins during business cycles. Now, if we see here, this is the Shiller PE over the last 20 years. The ratio reached its highest point right here in November of 2021 in the range of 38.6. That's 47% above the PE of the last 20 years, the average, which was 26.2. If we look at this chart all time, the Shiller PE this is over 100 years, we can see that November 2021, the pandemic stimulus-induced mark was eclipsed literally once since it's been tracked. Right here, this was the dot-com madness in 1999 when it hit roughly 44. So now we have some historical context. The question now should become, where are we today in terms of valuations? Well, the Shiller PE is 31.1. That is about 18.3% higher than the recent 20-year average of 26.2. It's far better than the range of 38 that was hit in November of 2021, which was 47% above the PE of the last 20 years. However, it's instructive to point out that the Shiller PE is still 78% above its all-time average of 17.4, indicating we are not nearly historically cheap. It's better than the peak, but the risk remains and the market is bifurcated. Now, this is a simple chart here, courtesy of Yardeni Research. I'll take the simple part back when I look at it. It looks like a plate of rainbow spaghetti, but let me try to make some sense of it here. It shows the valuation disparity between the large and mega cap stocks represented by the current forward PE, which is in red and purple lines respectively, and the small cap universe represented by the green line there, formed by the S&P 600 small cap index. As we can see here, the forward PE on the mega cap 8 and the S&P 500 is significantly higher than that of the mid and small cap indexes. Now, because this is a bit of a plate of spaghetti here, it's difficult to take in. Let me just present these straight numbers for comparison purposes. This is the mega and large cap versus the small and mid cap stocks. The forward-looking PEs, if we can see the mega cap 8, about 25.1 right now. S&P 500, 17.4. Versus the small and mid cap. Well, the mid caps are at 12.4 and the small cap 600 is about 11.5. If we drill down on the large cap versus small cap story even further, this is since 2005. The S&P 600 has historically traded at a premium to their larger cap S&P 500 counterparts. But as we can see today, small caps trade at a significant discount to their large cap brethren. Again, this chart shows the relative valuations have swung significantly in favor of larger cap companies. Of course, not all, in favor of small cap companies, really the divergence there in terms of valuations. Of course, not all small cap companies are opportunities, nor should all large cap companies be avoided. But there could be a significant opportunity here, generally opening it up for long-term investors that are looking at high quality, value and growth-based small cap stocks. Thank you. And you guys got any comments on that, or should we just move on? And
you're muted.
Aaron's muted. So Aaron is trying to comment, but nobody wants to hear him, so we muted him. Is he back?
He is not.
There okay, I'm back now.
There, he's back.
One of these days,
maybe he fell off his chair.
Just go on and just nod your head and say that's interesting. And move to the next.
That's great.
I did notice in the chart there that the valuation discount did narrow slightly over since 2022. I don't know if there's any comments on that or there's any rationale there.
I think like these numbers were at November, so we're gonna have to pull up the numbers because there has been kind of a narrowing. Although the Magnificent Seven has done quite well again in November as well. So we might have seen a raise and a raise. I think there might have been raises on both ends. But I think the key point here, too, is when we're looking at it, we've seen the highest quality, cash-rich, growing cash flow, small caps really get a bump up in the last month and a half. Whereas, if you do not have those, if you don't check off those boxes, you're not getting the bump. So at least the market is being selective and I think rewarding the right companies, which is nice to see. But, if you can find a company that marries those 2, 3, 4 items, growth, trading at a reasonable price, good balance sheet, they're certainly getting rewarded. Like we're not going to say the name of the company, but again, we just recommended a company, 2 companies, but one in the start of September, it's up 65% since then, all just really driven by quality results. And then another company that was just a month, 3 weeks ago, and the stock has gained 30% in less than a month. Again, driven by good numbers, but both of them check off that good growth right now, good growth expected over the next year, strong balance sheet, and just traded at reasonable valuations. So you're seeing those type of businesses. I've heard people say, "Is it value stocks?" I think it's growth and value. So growth at a reasonable price that have really been kind of recognized over and are starting to get a kick up in terms of the market. Perhaps the lesser quality, if there is a play into small caps, start to pick up. But again, I don't want to be invested in those companies. I would be the ones who lead the market, the high quality names, and those are the ones you want to look for.